So, can we start? Nadia? Nadia? Okay. So let's start then. First of all, do you have questions regarding what you have done before, last time? Tanya?
I don't have questions, and I wanted to say that I have problems with internet connection and my camera might turn off sometimes by itself.
Okay. Let me use, but how is the connection now? Can you hear me well or you have problems?
I can hear you, but some words are lost.
Well, I have the speed of my connection is about 2 megabits per second.
Yes, this is the speed because I live in a dormitory.
But let me use this thing. Can you hear me well? Better?
We can hear you okay. I guess it's just the Tanya's internet problems.
Okay. Good. So, again, do you have questions regarding what you have done? Everything is clear. So, Yekaterina, can you please summarize just a couple sentence what we have done last time? Hello?
Yeah. We talked about equities and how to how different equity styles indices accounts for and that's all that I remember.
Karen?
Yes, I can add that we spoken about some indexes, about, for example, Dow Jones index, about different types of valuing equities, like arithmetic, geometric averages. Yes.
Karen, what is an index?
Can you repeat, please?
Yes, what is an index?
Dow Jones index?
Yes,
or,
that is an example. What is a market index?
It's a weighted index of largest American companies.
No, just a second, Karen. If you ask you what is an index, in this case, a market index, you cannot say an index is an index. No? It's clear what I mean.
I guess I understood. Index is like average value of something, or I don't know.
Nadia?
Sorry, could you repeat the question, please?
Yes, what is a market index?
Maybe it's some measure of something in market.
Yeah, is a measure and indicator, and then is made in different ways. For example, the Dow Jones. How is made the Dow Jones? You call it which way? Daria?
The Dow Jones index is a price-weighted index, so
Very
it's
good. So go ahead. Go ahead.
well, it's a sum of prices of stock prices of 30 largest companies adjusted by some number to account for splits.
Yeah, if there is a split or the opposite, if there is a merge, then you have to take into account this because you don't want to change the value of the index. So an index is an indicator, is we said tells us how the market performs, but and is made how? Daria, you said before what?
How is Dow
Made
Jones index
built,
made?
yes, is built based on what you said?
Based on stock prices of 30.
Prices. Okay, stock prices. Very good. So stock prices, and then there are different kind of indices that are not price weighted, but also are market weighted. Correct, Daria?
Yes.
So, for example, the MCI or FTSE indices are made in this way. And what is the meaning of market weighted?
Instead of stock prices, they take market value, which is stock prices multiplied by the number of stocks.
Yes, or issued stocks or traded stocks or whatever, no? This is, and an index at the end is an indicator of the market performs. And we said that there are different ways to build it. But at the end of the day is a sample. Yes?
Yes.
It's a sample because, and then you have different ways to build a sample because we said that samples should be representative of the population, the total population, no? So we made an example which, you know, regarding people, polls, but the same is for indices. So you have, for example, a certain proportion of financial stocks and a certain proportion of energy stocks and so on. So this is one thing. And then, Nick, can you add something about what we said last time, apart from indices?
Well, apart from indices, we've mentioned the market as a, I don't know, as a term. We've mentioned the qualities, the properties of a good market, and we also talked about bonds, equities, and I don't know, and a Russian direct investment fund. Now I know that it exists.
Very good. And so we know that anything we want to exchange normally is exchanged where? Normally, where is the best place where we can trade, exchange things? Into a...
On the market?
Okay, very good. on the market. So we trade things on the market because we can trade, of course, between us, but normally trades are performed on the market. So that's why the market must be, can be any market, can be also the market, I don't know, the market next to your place. But to be a good market, then there should be some properties that there are some properties that should be respected. Okay, so for example, do you remember one, Nick?
For example, timely and accurate information.
Good. Information is very good. And then those information should be reflected where?
In prices.
Good. Because if you have this information, but this information is not reflected in price, then again, you may have a market, but that is not a good market. Otabek, do you remember anything else?
Probably not. Nikolai told about everything.
Well, another thing could be, for example, price continuity, no? Liquidity,
Okay.
and so on. So those are the characteristics of a good market. Again, we may have a market, but in order to say that the market is good, you need to fulfill some requirements, and those are some of them, okay?
Okay.
Okay, so let's start with the new class. Let me show the presentation. Can you see the presentation?
Yes, we can.
Okay. Okay, so you have those characteristics that we said. Liquidity, price continuities, because we don't want jumps and so on. So you can low transaction cost, information efficiency, and so on. So then I guess that we already mentioned this. There are two kinds of markets, primary markets and then also primary markets and secondary markets. Is that right? Did we mention it?
Yes, we did.
Yes.
Okay, so then which market is bigger?
Usually secondary.
Yes, and why? Correct. And why that?
Because the set of already used products.
Not used, Nick, sorry. Not used. Say another word, it's not used.
Okay. The set of already issued and
very good. Issued.
Already bought shares and bonds is just larger than the set of new one.
Good. So that is the reason. Okay. Okay, so let's move forward. And then we already mentioned these things, I remember, no? If that bonds can be distinguished or classified by issuer, maturity, placement. Did I mention this thing, the placement? Do you know the meaning of placement?
Isn't it the place where the security is sold in the first place?
No. Is the way in which is placed, so is sold to the market.
Okay.
So placement is not the location, but is the way in which is sold, the security is sold on the market. And then why that? Because you know, when you issue a security, then I remember that we already mentioned something like this. Let me check it. Where is it? The way in which you can sell securities on the market, the way in which you can issue a security through an investment bank or through auctions, public auctions, or private negotiated deals. Did I mention this to you or not?
I don't remember this.
Well, then maybe I will add 1 or 2 slides to tell you about this. But essentially, there are different ways to issue a security. One way is to make a public offer on the market. So everyone that is interested can buy it. And then how people can buy this? They should go to the bank, and then the bank would, is contacting directly contacts directly the company, and then the company provides the required securities. This is a way. Another way is that there is lead underwriter. Do you know what is an underwriter?
No.
So let's say, Nick, let's say that you have a big company, no? And then you want to sell or issue a number of bonds, and then for you it's difficult to contact every bank in the world, no? Then what would be the most practical solution for you?
Maybe to contact some particular organization which can help me with that.
Yeah, but we are talking about money. So which kind of organization?
Like huge bank?
Okay, so you contact a bank, and then you ask this bank, do you want to buy the bond from me? Because then it will be much easier for you, no, to contact just one company, not to deal to many companies, but just one. So a way for this bank to deal with you is to say, okay, I buy this issue for the full amount. And this is normally called lead underwriter. Do you know the meaning of underwriter?
Not really.
Is the buyer, is the one that bears the risk. So I will add a couple of slides about this, so you can learn. Then you have a lead underwriter, and this underwriter, we said that bears the risk. Of course, to do this, he requires a compensation. This is clear, no? But then, what is the best way for this lead underwriter to minimize the risk or offset completely the risk? Karen? Karen? Dimitri? So we said Can you hear me, Dimitri?
Okay, sorry, I missed your question. Could you repeat this?
Yeah, I'm going to repeat it. So we said that there is an underwriter, and this underwriter is the one that buys the bond from Nick. So we said, so for example, 1 billion of rubles. And this underwriter is the one that bears the risk. What would be the best way for this person to offset completely or partially the risk? Because everyone wants to minimize the risk, no?
Maybe this person can diversify the money between several stocks. That's why he minimizes the risk.
No, Dimitri. You are the underwriter, okay? You buy 1 billion of rubles from Nick. So you have this risk. What you should do in order to reduce this risk? To offset completely or partially? Any idea? Otabek?
I don't really know how does Underwriter function. I
Sorry?
just know the definition, but I cannot answer this question. It's kind of hard for me.
Okay, Otabek, let's think about. So you have this money, okay? And you
Okay.
give this money to Nick, and then in exchange you have a bond.
Mm-hmm.
But if you have a bond and you have a risk, yes? So what you should do in order to reduce or completely offset this risk? Where it comes from this risk?
From the risk of default, something like that.
Yeah, you are right. But it could be the default of what? Default of what? What you have in your hands?
Default or some uncertainty.
Yes, I understand it. But Otabek, what is defaulting?
Cash flows, just fixed cash flows of the bond, coupon payments.
Of the bond. So it could be a default of this bond, correct?
Yes. Yeah.
Okay. So where comes from the risk? From the
probability of default.
Okay, you have cash in your hands, okay? Let's say that cash is riskless. You gave cash to Nick. In exchange, what you got?
I got bonds.
And this is riskless or not?
They're risky.
Okay, so you have something that is risky. Now, in order to reduce your risk or to complete offset your risk, what you have to do?
I can buy some insurance.
Or you can sell the bond.
Or I can sell the bond.
If you give away the bond, good, Dimitri. If you give away the bond, do you have the risk?
No, I have cash in exchange.
Exactly. So you had cash, but you gave cash to Nick because you want to make money, correct?
Yes.
But now you have a risk because you, in exchange of your cash, you have a risky asset. So in order to make money, but to not risk anymore, you sell the bond. So when you negotiate with Nick, maybe we said that you are underwriter, correct? Then you contact other banks and you say, okay, I'm underwriting this bond, but I will sell you, so to other banks, I will sell you 10%. You sell to Daria 10%, you sell to Dimitri 50%, you sell to Nadia 20%. So what happens? That you buy this bond from Nick, then you get a percentage, and then you sell the bond, the same bond, to your friends, to other underwriters. In this way, you don't have any more the risk, but you get a commission. Okay? It's clear to everyone?
And what do you mean by commission? Is it
Okay,
something
let's say the following. So let's say that the bond gives you at the end, at the maturity, pays 100, for example, no? We know this, plus an interest, okay? And then Nick maybe sells this bond to you at 96, okay? And then you sell this to your friends at 97.
Mm-hmm.
So you made a profit of 1 for each bond that you sell. It's clear what I mean?
Yeah. So this difference is called commission, yeah?
You get a commission. And could be a percentage, or could be just, as I said, is 1 ruble, whatever, for each 100 and so on, no?
Mm-hmm.
You get this, the difference between what you paid to Nick and what you got from your friends is your profit. And then it could be that you sell everything or you keep something for yourself, okay? In this case, you are the lead underwriter, and your friends are underwriters. But then your friends can do the same with their clients. So Nadia is an underwriter, she's buying the bond from you at, we said 97, no? And Nadia can sell this bond to his clients. Nadia, how much you want to sell it?
I don't know.
Tell me a number that makes sense.
Okay, 10 maybe.
So you paid 97 to Otabek and you want to sell it at 10?
I understand. Yeah, I paid 97, so about 100 or more.
Okay, so you sell it for higher value. That could be, for example, 98, 99. Okay, so you make a profit as well. It's clear, Nadia?
Yeah, it's clear.
Okay, and then your clients can be either, I don't know, retail, so people that have an account, normal families that have an account at your bank, or they could be institutional clients, pension funds or insurance, whatever, okay? It's clear for everyone, this idea, the way in which the things can be placed on the market, securities can be placed on the market. Yes? Vladislav? Hello?
Hello.
Yes, it's clear or not?
I believe that it's clear, yes.
Good. Okay, so the placement is what we said, and then information. Okay, so you can read this by yourself. You don't need me. Maturities, private placement. Yeah, this is what I mentioned before. Then can be different kind of placement. Then can be competitive bid. Competitive bid. Do you know what is the meaning of competitive bid?
Doesn't it look like some kind of auction?
It's similar. Yes. There are. Do you know the meaning of bid, Nick? When someone is bidding, do you know what is the meaning?
So they are stating that they are willing to buy this lot on this price.
Yeah, correct. So they make an offer. They say, okay, I want to buy, I don't know, 10 bonds for 95. I want to buy 20 for, I don't know, 97, whatever. No, this is the bid. And then there are, in this case, there are different banks or different underwriters that they compete. So they offer different prices, and then you have this kind of competition between them. And then there are negotiations. You deal just with one, okay? Normally. And then also you have private placement. When you place the bond with a specific company, and you don't negotiate with anyone else. Okay. Here you have the description, and if you need me for explanations, next time we will clarify your questions. But you can read by yourself. You don't need. This is what I mentioned before. This is the scheme that I mentioned before. That there is the underwriter, then the underwriting group, the selling group, and so on. Investors, institutions, individuals, and so on. And then the privilege. We already mentioned there are preferred securities and common securities. Do you know the difference between them, Ekaterina?
Yeah, so preferred securities have
Yes.
issues. People who have preferred securities have rights to change some choices of companies.
No. Daria?
Preferred securities are the ones that give you voting rights.
For example, it could be preferred in terms of voting rights. So instead to vote one share, one vote, could be one share, two votes, for example. Or do you have an example, Daria?
Another example, maybe the owners of preferred securities get paid first.
For example, if there is there are no much dividends, then they get those dividends first, or in case the company is liquidated, then the first to get the assets, the proceeds from this liquidation are those owners, or they may get some preference in terms of, I don't know, dividends, in the sense that they get more dividends than the others. So it could be preferred in different sense. So season is what we already said, and there are stock outstanding, and then IPOs. Do you know the meaning of IPOs, Daria, still?
Initial price offering.
Yes, what is the meaning?
It's when the shares are offered or issued for the first time in the primary market.
Correct. And then normally they are offered to everyone, to all investors that are qualified. So you can read by yourself this. I will not explain it. And again, if you have questions, you will ask me. Well, asset classes, we have bonds or equities or commodities, whatever. Do you know, I remember that I mentioned this already. Nadia, do you remember what is the meaning of OTC?
I don't remember.
Dimitri? Tanya?
I just remember briefly that it's some kind of a sheet of trading that is done between two parties.
So normally you have regulated markets and then the stock exchange in Moscow, no? Do you know the name of the Moscow Stock Exchange, Tanya?
What, excuse me, the internet
The name
connection?
of the Moscow Stock Exchange.
No, I don't remember.
Well, who knows it, or you do it as an exercise, you look for it later when we finish this class. Who knows it? Well, anyway, so
Moscow Stock Exchange.
yeah, the name. It's called
MOEX.
Okay, and then you have an index, no? Otabek, you know this, no?
Yeah.
Okay, you have an index, and then this is we said that an index is a sample, correct? Tells you how is performing the stock exchange. And by stock, we mean, you do know the difference between bonds and stocks, no? We don't need to mention it. Okay, so let's go back to this regulated market. A regulated market is when there is a transaction and there is someone in the middle between the transaction. So, Tanya, let's say that you want to sell something, stock, and then I want to buy that stock. But it could be that there is a risk in this. Which kind of risk could be? There could be.
That someone won't be fully integrated.
You want to give me something, okay? And in exchange, so a stock we said. And in exchange, I have to give you what? In exchange of your bond or your stock. I should.
An agreement?
Yeah, there is an agreement between me and you. You give me the stock, and what should I give you in exchange of that? Money, no?
Oh, well, yeah.
You sell something, and then I should pay you, okay?
Yes.
Good. So what could be the problem in this case?
Maybe the problem of supervision, that this agreement is only between the two of us, and it should be, like, clear.
The problem could be that you give me the stock and I don't pay you. So it's default. This is called counterparty default.
Oh yeah, that's what I meant. Like, there has to be some kind of a supervision that each side does the needed actions.
Exactly. And this is called counterparty default, no? Because it could be that you don't give me the stock, or the opposite. What could be the opposite? In exchange, what should I give you?
You should give me money.
So what could be the problem then? that you default with the delivery of what? Of the
of the bond that I give to you.
okay, that you promised to give me, because we have a contract, we have a deal. And the opposite could be that I default with what?
With the payment?
With the payment, correct. So this is called counterparty risk. And then what happens? If there is a regulated market, there is supervision, whatever, but normally you deliver you deliver, Tanya, the bond to the market. And I deliver the money to the market. So in this case, we avoid this counterparty default because the market knows that you have delivered this. It's clear what I mean?
It is. That
the
both
market
sides meet
knows
the
that I
requirement.
delivered. Exactly. So when there is an exchange for sure. There is no risk anymore, because 2 days before, 3 days before, depends on when the trade is executed. Then you already delivered and I already delivered. So it's not possible that me or you default, because the market has, from my side, the money, and from your side, the bond. Okay? Then this is negotiated markets. But then there are organized markets. So then there are cases which the market is over the counter. Over the counter is just a negotiation between independent parties. So it could be between a bank and me. So the bank or me, one of them can default. You know that there were cases in which banks defaulted? Tanya?
For example, when they have a lot of loans.
For example, there were banks that defaulted, and then we had this situation. Did you see the movie that I suggested, that Otabek shared with everyone, The Big Short?
Not yet.
So try to do it. So there you will see that there are instances in which the banks do default. Otabek, do you remember a bank that defaulted?
There were multiple banks, as I remember.
Just one.
Citibank, HSBC.
No, they didn't default. Defaulted. That went bankrupt.
Allowed example is the Enron company in the 2000s.
Enron, yes, but Enron was trading. That's why defaulted, no?
Oh, yeah.
And then we were talking about banks, and then just look on internet or Tabek, please watch again that movie. You will find that the banks that defaulted. So there are banks that can default. So Tanya, not only you as an individual can default, but also the banks. So when we are over the counter, we say that this could be between banks individuals, and it could be that one of them can default. Okay. And then there are poor auction or dealer markets. Do you know the meaning of auction?
We've already discussed it during the competitive bid discussion.
Yes, but pure auction is when every time, not only once, but every time there is what, Nick?
there are bids and there is only one, I don't know, winner. Well, in the traditional auction.
Well, there is someone that wants to sell, and then there is someone that wants to buy. This pure auction is that case. And the dealer, do you know the meaning of dealer market?
And the party who wants to sell or buy, so they are just traders, no?
No, if you want to buy a car, for example, you go to a dealer normally. And do you know what the dealer does?
In fact, this person is a mediator between the producer and the final consumer.
Correct. And normally you have a dealer for, I don't know, for Suzuki, a dealer for, tell me another brand, I don't know, Autovats. Is the Autovats, yes?
Yes.
And then you have dealers that are specialized with some companies. So a dealer market is a kind of intermediary between you and the producer. So in the case in which when we talk about stocks, then you have a similar situation. So for example, IBM stocks or I don't know, Gazprom stocks and so on are dealt, so are sold by this person, by this company. There is one company. And then there are markets that are continuous. Do you know the meaning of continuous? The following.
Not discrete or not in this meaning?
Yeah, and continuous means not discrete. So there are no intervals. So every time, every second, whatever, there is a price. There is an exchange. Okay. And instead, there is another market that's called call market. Did you ever watch a movie where, normally about Wall Street, whatever, in which there are people that are shouting? Yes, Yekaterina, what they say?
So people, I don't really
Sorry?
know. I don't really know, but it was people actually called to make a buying.
Yeah, they shout, they say, I want to buy this, I want to buy that at this price, in this quantity, and so on. So call market is when there is a time in which all the requests are put together. And then on the other side, if we have requests, so if we have bids, on the other side, what we should have. Ekaterina, we are talking about a market, no? If we have a bids, what we should have on the other side.
To what?
Okay, let me say it again. Let's say that you want to buy stocks.
Mm-hmm.
So you bid, you make an offer, okay?
Mm-hmm.
But in order to get this stock, someone should do
So
what?
in call market, I should bid the highest price?
No, you bid, you make a bid, and you make a bid at your conditions. I don't know, you want to buy 10 stocks at 95, 200 stocks at 100, okay? This is your bid. And every one of us is making a bid. But then, in order to have a transaction, what we should have on the other side? Remember, then when there is a transaction, there are always two sides, no? One side is the bidder, and the other side is
Who offer the...
Exactly. And then, okay, so what happens when you have a call market? That many people make their bids, and then they are put together, and then on the other side we have an offer, and the stocks or the bonds, whatever, are sold depending on the bids that are made. So, for example, if I made a bid for 100, and you made a bid for 95, in your opinion, who will get the stocks?
So
I bid that for 100, and you bid that for. I see.
The highest price will get the stock.
Very good. So this is one thing. So, but if I bid that, let's say that on the market are offered 50 securities. Okay.
So
on the market are offered 50 securities, and I bid for 20. Okay.
Okay. And
so what happens? That I bid for 20, I will get on the market. On the market are available 50 securities, and I bid for the price of 100. I bid 20 securities, not all, but only 20. Ekaterina, can you follow me? Yes? So, if you bid, we said, for 95. Yes?
Yes.
And you bid, I don't know, 10. What will happen?
So I want to buy all the 50 securities, or so as I understood, 50 securities is offered for 100. Uh-huh, 50 available for 100. Or what?
Can you read it?
20 securities, okay, for the price of...
So how many securities I get?
20, as you want.
Okay, and then you bid, for example, at 95, okay? Ekaterina, can you follow me? You bid for the price of...
How many securities?
Tell me a number, how many?
Like 30 others?
No, tell me a smaller number.
10.
Yeah, okay, you bid 10 at the price of 95. And, I don't know, Tanya. So, can you read what I'm writing?
Um, 100.
Ekaterina, can you read this chat?
Yeah, I can, but Tanya bids 100.
Yes, at the price of 80. So how many stocks Tanya gets?
She'll get only at 20.
Yes. Is this clear to everyone? Tanya? So go ahead. Sorry, Ekaterina.
person who offered the highest price will get all
for
the
sure will get the stocks, okay? But
all
what is the
numbers.
problem for this person? The problem for this person is that will pay
And the highest price.
the
More
highest
than
price.
others.
You are less interested in this stock, so you don't bid for the highest price. You bid for a lower price. Yes, but you have to pay still how much?
Still 95.
95. So you save some money, 5 rubles, whatever, with respect to me, but you have to pay that money, okay? 95. And then there is the last one, which is Nadia, who is Nadia. And then Nadia can pay the smaller price. Yes? But what is the problem for Tanya?
She will not get all the number she wants.
Exactly. Okay.
So it's call market.
This is the call market, yes. Continuous market is different, and then there are variations every time, you know, is what we said. Okay, so you can read this by yourself. The vast majority of bonds and derivatives are traded in OTC markets. And regarding the counterparty risk, let me share with you this. If you are interested, you don't need to read it, only if you are interested. I share with you this. Let me see. So when I was working for Allianz, I did project regarding this. It was about 2,000 billion of euro. So 2 trillion. And then regarding counterparty risk, in that case, you can read if you're interested. You don't need to do it if you don't care. And this is the book that I published this year on counterparty risk. Because we said when we have this kind of trades, we do have this problem with the counterparty, okay? Clear? So then here there is an explanation of different kind of markets, and then I think that for today it's all. No, that's all, because we should finish at this time. Is that right or wrong?
We have 20 more minutes.
Ah, very good. So we can go ahead. Do you need rest or we can go ahead without problem?
Well, we now have only 20 minutes till the end, so probably we shall go on.
Okay, so let's go ahead. So there are different kind of orders. And what is the meaning of order in this case? Daria?
I think it's a bid or an offer that is placed in the market or somewhere.
Exactly. So orders are, or so the what you ask, I don't know, your dealer, your bank, whatever, to execute on the market. So there are these kind of orders. And then when there is a market order, before we made an example, no, we had the case of the bank, then which is gathering like in a coal market, no, is gathering all together the orders, and then or the stock market, and then we said that there is then puts the orders according to the price in descending order. So that is a way. Another way is to have a continuous market, is what we said before, in which you see that instant by instant you have different kind of change, different prices. So you have difference in the prices are changing depending on the match between the bid and the offer. Okay. So market orders are those orders that are placed according to the prevalent price in that moment. So if the price, with Ekaterina, before we made an example, Ekaterina, we said that in the coal market, I make a bid, you make a bid, Tanya is making a bid, and then according to what we bid, then the securities will be allocated to the bidders. But when we have a continuous market, the point of reference is the current value of the securities. So if the value of the stock is 100 and I make a market order, that means that I give the instruction to the bank to buy or sell at that price, so at 100, not at 50, 60, 95, what we said before. It's clear?
Could you please repeat the idea?
Okay. Before we mentioned coal markets.
Yes.
Okay. And then we said that in that case, you can bid for different prices. And we made an example. I bid for 100. Ekaterina was bidding for 95 and Tanya for 80, no? Remember it? In this case, what happens? When markets are continuous and you make a market order, it means that you tell to the bank to buy or sell at the current value, at the current price. So if the price that you see on the market, if the price that you see on the market is 100, you bid or you buy or you sell at 100 or around that figure, that price, not at 50 or 200. It's clear what I mean, Nick?
Yes.
So if I want to buy, I have to pay 100. If I want to sell, I will sell at 100. I cannot sell, I don't know, at 200.
Well, theoretically, I can try, but no one will buy it, so...
Yes, but the order that you give to the bank is not for 200. You give the order to the bank. We are talking about the order that you give to the bank. The order that must be executed. Okay? Daria, can you follow me?
I think so.
Okay, good. So when you give this kind of order to the bank, you say to the bank, I want to sell, or I want to buy at the price that I can see now on the market. It's clear? Good. So now there are limit orders. And these kind of limit orders are the ones in which you can say to the bank, okay, let's say that I'm the buyer, and I see on the market that the price is 100. I say to the bank, okay, don't buy at 100. Buy only if the price goes, I don't know, below 50. Yes?
Yes.
And it could be the opposite. I'm the seller. I say to the bank, don't sell my stock on the market, sell only if the price is more than 150. Okay? This is the kind of order that is called limit order. And open-ended, what is the meaning of open-ended? It means that is good until when is cancelled. So there is no limitation regarding this kind of order in temporary, I mean. So it could be that this order stays forever. So for a month, for a year, for 100 years, it doesn't matter. No, there is no end to this kind of order. Then there are short sales. Do you know that you can go short on the market?
Yes.
And Tanya, do you know the meaning of being short? Having a short position?
It is connected to time, so you don't take long. You don't buy bonds for a long period.
No, it has nothing to do with time. And Daria?
Well, I kind of can see it on the slide, but it's when you borrow the stock and sell it.
Yeah, when you let's say in this way, who owns the risk when we talk about securities? You know, there are, when we have we make an investment, sorry, don't know what happened. When we make an investment, there could be two possibilities, one positive and the other one negative. What could be the positive possibility?
That the price goes up.
Okay, good. And then we have also the negative possibility. And what is it? That
the price goes down.
Very good. So you have two sides, no? And then let's say that you think that the securities will go up. What you do then?
If I think that they'll go up, I buy them now.
Okay, but if you think the opposite, that the securities will go down, what you will do?
Then I sell them.
You sell it, but you don't have it. So what you have to do then?
If I don't have it, I borrow it and then I sell it.
Exactly, exactly. This is the thing. You borrow the security, and then you sell it, and you get some money. Okay. Well, you know, for example, you get 100 rubles, and what you have to do later? You have to give back, because this security is not yours. No, you borrow. It means that you have to give back this security. Is clear what I mean?
Yes.
So you sell it for 100 and you hope what?
That it will go down to 90.
For example, and if it goes down to 90, what you do?
Then I buy it for 90 and give it back.
And you give it back. So this is the idea about short sales, okay? So you borrow the security and then you sell it. And then you hope that the market will go down and then that the price will go down and then you will buy for a lower price. And this way you can give it back to the lender. But what is the problem? That it could be that you buy, you borrow at the security and when the price is 100, okay? Yes?
Okay.
And what do? You buy so many securities for 100 that then you sell them. And even though is just temporary, you push down the price, you reduce the price of the security that you are selling.
Yes.
So in this way, you can make a profit, but this profit, is because you trick the system, no?
Well,
So
wouldn't the price go down like immediately?
well, if you borrow many securities and then you sell them on the market, you may change the market, you may change the price.
Yes, I mean, if the price is really what it's called like reacts really quickly to new information, then maybe
No, we don't talk about information this moment. We talk only about the equilibrium between demand.
Okay. I mean,
yes.
If I sell this stock for a lower price, I might sell them for the lower price because
no, you borrow this price when the price is 100.
Well, yes, that's what Nick is writing, that prices are sticky, but I mean in theory.
No. In this case, there is no stickiness.
Okay, I mean, did I get it right that you are saying that I will push down the stock price and make profit?
Because exactly. So what you do if you borrow many stocks, okay, and you sell them, then there would be an excess of offer of those stocks on the market.
Yes.
Let's say that you buy, I don't know, you borrow, for example, 30%, 40% of a company, and then immediately you sell them. You sell those stocks. What happens to the price of the stocks?
Well, sure, it will go down, but wouldn't I sell them for that lower price?
No, you sell at 100 because the price is 100. And what happens when you sell those stocks? That you bring down the price of the stocks. Yes?
Okay, so it doesn't adjust.
No, is adjusting, but is adjusting in the sense that you make a gain. Yeah, Nick, you dump them and then you sell them and then you influence the price of those stocks in the sense that you flood the market with many stocks. And if there is more offer than demand, what happens to the price?
It decreases.
Good. So, for example, you sell the first batch at 100, then the second batch at 99, and then again at 98, and so on. You push down the price. Yes, Daria?
Yes.
And then let's say that you push down the price up to 80, for example.
Mm-hmm. Yeah,
And then,
I understand.
And then you buy, because you need to give back this money, sorry, to these stocks, no?
Yes.
Then you start to buy when they are at 80.
Okay.
And then you make money because you sold them from 100 to 80, but then you start buying from 80.
Yeah, I understand, yes.
Okay. So to avoid this kind of problem, if you borrowed at 100, you cannot sell at 100. You have to sell at a higher price. So, for example, 110 or 105. It's the uptick that is decided on the market. You see this?
Yes, I do see this.
Is it the rule?
This is a rule, uptick. This is a
Okay.
rule. Otherwise, you can distort the market. Because what you want to do is to bet on the fact that the stock will go down, but not because you changed the market, but because you made the right guess regarding the movement of the market. Daria, is this clear?
Yeah, it's clear.
Tanya? Ekaterina?
Yes, it's clear.
Yeah, it is.
Nick?
Yes,
So
it is clear.
that is the thing that then again, when you can be short, and Tanya, short is not a matter of time, but is a matter of price, no? Of the fact, sorry,
Yes, yes.
that you take a position on the market. And to be short, it means that you have a negative view of the movement of the price. So you think that the price will go down. Instead, the opposite is when you are long. In long, it means that you bear the risk and then you buy the stock. Yes? So there are two opposite views. To be short, it means that you think that the stock will go down, and then you take this position, negative position. And then to be long, it means that the opposite is that you have a positive opinion about what is going to happen to the company and the stock and so on. So I think that that's all for today. So last question. Is this fine in this kind of ideas that I give you about the market, or you don't like it? So Nick.
Many things are interesting, but some things we've discussed on other courses.
Mm-hmm.
So maybe some well, some more advanced topics could be useful as well as some mathematical approach, if you ask me.
Well, yeah, would be later on because now we are discussing about the markets, how the markets
Okay.
behave and so on. But if I tell you something that is not that you already done it, then you tell me. You say, Professor, we already said this, or we have already done this. Because normally I ask questions, and based on the questions, I try to understand if you know that topic or not.
Yes, okay.
Okay, good. So I wish you a nice afternoon then.
Thank you.
Bye-bye.
Goodbye.